So two best Canadian dividend stocks that you could invest in this probable coming recession. So the stock number one is Canadian Natural Resources and the ticker symbol for that is CNQ. It is currently trading at 80.7 Canadian dollars and the current dividend yield for that is 4%. So the CNQ is increasing their dividend for the last 23 years along with their special dividends. So why CNQ? Even when the oil prices will go down in 2023, CNQ will be greatly profitable considering it has a low cost of production estimated by the management around $26 per barrel and the free cash flow break-even is estimated around $31 per barrel. So if we see the current price of North American benchmark WTI, it is around $80 per barrel, so they are wildly profitable when the oil prices are high. So even if the WTI goes down to $40 a barrel, this company will be cash flow positive and will pay dividend to their shareholders. But right now, CNQ is enjoying high oil prices and high free cash flow with which they already paid some of their debt last year itself. So currently their dividend payout ratio is 27%, meaning dividend is very well covered by its earnings. So the biggest advantage of CNQ to its competitors is its lower production cost. And because of this edge, it's currently trading at premium valuation. So let's check some statistics about the CNQ. So its price to earning ratio is around 7.4, which is little bit higher than its competitors. However, I personally feel that it is justified considering CNQ is enjoying some amazing profits with which they paid down some of their debt last year and also allocated some capital to acquire properties to increase the production and cash flow. And this year with the cash flow, they will focus more on the share buybacks and dividend growth, and you can also expect some special dividends as well. So I feel that the company is in very strong position right now. In a nutshell, lower production cost compared to the competitors, higher oil prices, debt repayments and strong management team of CNQ will definitely benefit this company in future. So last year this stock gave more than 21% returns along with good 4% dividend and is currently trading at $80. I am confident about the dividend of the CNQ. However, I would like to wait a bit for the correction to buy some more stocks because it is expected that the oil prices will go down a bit, which will affect the stock price. But on the other hand, if China will fully reopen from its zero COVID policy, then the oil demand and the consumption will go high, which will again increase or at least keep the prices at the current levels, which can benefit CNQ to generate higher free cash flow. So before I reveal the stock 2, I would highly recommend you to check out my previous video where I have covered 4 amazing Canadian dividend stocks. You can find the link here in the description and I will also provide that at the end of this video. So the second stock I want to talk about is Canadians' current favorite utility company, Fortis. You can see the comments of the previous videos where our friends like you showed their love for Fortis. Let me know in the comment section if you are also holding Fortis or if you are planning to buy some. So the stock is currently trading at around 56 Canadian dollars with the dividend yield of 4%. It is increasing its dividend for the last 49 consecutive years, which is amazing. Its earning payout ratio is around 79% as you can see on the screen, which covers the dividends. However, it's not very good but also not very concerning as well. There is one red flag for Fortis which I'll mention shortly. But before that, considering the uncertain economic outlook for 2023, this utility dividend paying stock could be a safer place to allocate your some capital for some passive income. So the price to earning ratio for the FTS is around 20, which is comparatively high to its peers. And the reason could be like Fortis has a very stable and reliable business model which generates recurring revenue and allows Fortis to pay generous dividend. So investors find this company as a safe bet and pays premium price for the stock. So at the current price level, we could not expect higher returns on the capital until and unless you have scooped up some stocks during the correction last year. So lastly, the one red flag for the Fortis which I found is its negative cash flow, meaning company is paying out the dividend but they don't have the cash flow at all. So now let's summarize both the stocks. So first is the CNQ. So currently CNQ is highly profitable due to the high oil prices, which allowed them to pay down some of their debt, which gives some flexibility to the company to increase their dividends. If the oil prices will go down up to $60 a barrel, CNQ will be in a good shape to provide the dividend. However, it will negatively affect the stock price. Management is strong and capable. Try to buy some stock during the correction for higher capital growth. So now if we talk about the Fortis, then Fortis has a reliable and stable revenue from its operations which allow them to pay good dividends. Their dividend is increasing every year. One red flag which we already talked about is its negative cash flow and is trading currently at premium price. So thank you very much for watching this video. If you find my content helpful, then please do like, share and subscribe the channel. If you have any questions or if you want to share something, please comment down in the comment section and I will try to reply as soon as possible. And this video is just for an educational purposes. Please do not consider it as any recommendation or financial advice.